All attendees are in listen-only mode.
Welcome, and thank you for joining us for today's webinar entitled A Look at the Top 10 China Financial Technology Trends for 2013, brought to you by Kapronasia. My name is Paul Robinson. I'll be acting as the webinar moderator. After a dynamic 2012, China's financial industry faces new challenges and opportunities as we move into 2013 and the upcoming year of the snake. In this informative 45-minute webinar, we'll take a look at the top 10 China financial technology trends and explain how they will affect technology spend of banks and financial institutions. Traditionally, Kapronasia's reports have focused on China's banking industry. In 2013, we'll be expanding our coverage to include the top 10 trends in China's capital market sector too. As we're somewhat limited on time today, we'll share with you all of the top 20 trends from both of these reports, but only go into detail on 6 of them. The remainder will be covered in the individual reports, which will be available on March the 15th. Now, I do need to inform you that today's session is being recorded and is run in listen-only mode. However, we really want to encourage feedback and questions from you throughout the webinar. To facilitate this discussion, we're going to use 2 features of the software. The first is the attendee viewer, which is made up of 2 parts. Now, there's the viewer window where you'll see the presentation, which I'd recommend maximizing now so you can see it in full screen. The second is the control panel, where you're able to interact with us. The control panel can be open and closed by clicking on the arrow button on the Grab tab. And in that control panel, you're welcome to submit questions and comments to our presenter. We'll be answering as many of these as possible throughout the presentation and at the conclusion of the webinar too. And with all of our housekeeping out of the way, let's get started. Our presenter and host today is Zenon Kapron. Zenon is Managing Director of Kapronasia, and he's joining us from Kapronasia's head office in Shanghai, whereas one of Asia's leading providers of independent research, custom consulting, and advisory services focusing on the financial industry and financial technology, they help clients understand and navigate the challenges they face in a challenging region with a rapidly changing business, operational, and technological environment. So to get this discussion started today, let's hear from Zenon. Go ahead, Zenon.
Thank you, Paul, and thank you everybody for attending today. I realize that we're just going into the Chinese New Year holiday, and for those of you here in China, that means a well-deserved week off, and for everybody else in Asia, a couple of days off. As Paul mentioned today, we're very happy this year to be able to expand our coverage in the top 10 trends to cover not only the banking segment, but the capital market segment as well. So if you had attended our 2010, 2011, 2012 top 10 trends webinars, you would have noticed that most of the trends were banking focused. So something that's new for this year is looking at capital markets as well. And that's also going to be reflected in the reports that we publish throughout the course of this year. So the independent research reports previously in 2012 were mainly focused on the banking and payments industry, but in 2013 we'll have more independent reports on the capital markets industry. And if you have questions about any of those reports or services, please do let us know, and we'll have contact details at the end. As always, our reports are based on a combination of secondary and primary research. So the secondary research relies on our internal knowledge databases, government, vendor, and financial institution reports. And then our primary research is with the interviews with financial institutions themselves, vendors, and industry experts. And really the purpose of this report is to, like the title says, to identify the top 10 trends in both the banking and capital market space, to give you an idea of the current situation of what's happening in the trends, the potential opportunities as a financial institution or as a vendor, and then forecast what will happen throughout the rest of 2013. Before we get into the actual trends, it makes sense to take a look at China's financial situation and the kind of the macroeconomic view of what's happening in the country. If you've been following what's happening over the past year, there's been a dramatic amount of change, both in terms of the regulation, in terms of leadership, and what we've actually seeing in the banking and capital market space. I think when I first arrived to China in 2004, a lot of the reform was around the banking segment, subsegment. So a lot of the commitments that China had with the WTO when they joined in 2001, they were starting to make good on those in 2004, 2005, up till probably about 2010. Over the past couple of years, I think what we've seen is a lot more regulation or deregulation, I should say, in the capital market space. So over the past couple of years, we've seen margin trading come on. We're hearing that short selling is coming soon. A lot of these reforms will definitely open up the market and really open it up both in terms of allowing more foreign capital into the market and removing some of the barriers and hindrances that have been a part of the market for years before. Certainly, China's demand for trade finance and international settlement in the banking sector will remain strong. Although we've seen slight dips over the past couple of years in China's exports, China largely still is the factory to the world, and we don't see this changing in 2013. Credit will slow slightly, and non-performing loans might become more of a risk over 2013. We talk about this a little bit later on in the presentation as well, but a lot of the bank financing tends to go to state-owned enterprises and large Chinese companies rather than the small and medium enterprises. So a lot of these small and medium enterprises have had to rely on other sources of funding, which don't necessarily have aren't necessarily the best situation for the small and medium enterprises. So, credit is going to be a big issue as we go forward in 2013, but that reform will continue. I think the government in their 12th five-year plan said that financial institutions need more business innovation. So we're expecting to see the gradual deregulation and reform of the industry continue over 2013. If we look more specifically into financial IT, both within the banking and capital market space, a result of all these reforms is obviously more investment in IT infrastructure, which is good news for all the vendors that are on the call. Banks will continue to invest to both kind of refit their existing legacy systems and to implement new systems to meet both the new regulations and new products that we're going to see coming onto the market. If you look at something like the financial futures that came onto the market last year, there's a tremendous amount of infrastructure that's involved in that, from risk management to trading to portfolio management. So a lot of those systems were just from that one initiative of the financial futures, but those will continue in 2013 as more products come onto the market and more regulation is put into place. Small and medium banks are still a good opportunity for a lot of vendors as well, often overlooked, but we continue to see a lot of reform coming from that space. And it goes without saying that the local vendors are a little bit more familiar with the market, and one of the keys for foreign vendors is localization. So for the first trends that we're going to look at today, we're going to be looking at the capital markets, the top 10 capital markets trends for 2013. Now, as Paul mentioned during the intro, we really don't have time during the course of this webinar to go through all of these trends. So we've picked out three trends in particular that we'll be focusing on a little bit more, looking at, first of all, the increased inflows of foreign capital into China, which is trend number one. Trend number 5, which is the emergence of new financial derivatives, and trend number 9, which is the increasing number of hedge funds entering China. One thing I should mention about this list, though, is that it's not by rank. It's a random order. So these aren't listed from most important to least important. These are the top 10 trends that we're seeing throughout the market. And I would encourage you, we'll have details at the end of this call about how to get the reports themselves, but the reports will go into a little bit more detail about the other 7 trends within the capital market space that we're not covering. So the first trend we wanted to talk through with you today on this webinar is looking at foreign capital in China. Really, this has been a story of China over the last decade, over the last 2 decades, is foreign investment into China. And it's been up and down. I think as we saw the global financial crisis hit, China kind of backed away from having more what they call the hot money coming into the market. But now as the economy is starting to slow a little bit, there's much more interest in a government push for more foreign capital to come into the market. So we're seeing that on one side, and then we're also seeing increased demand from foreign investors. When we looked at the QFE markets or the institutions abroad that were looking to invest in China in 2009, 2010, nearly all of the quota that the government had given them to invest in local markets was utilized. And we're seeing that again. We're seeing that the increased interest in investing in China. And that's really largely down to the fact that China is one of the best investment destinations in the world today, with GDP growth around 7 or 8% for 2012 and likely for 2013 as well. It offers a much better return for their investment. So that on the other side of the government's push for more foreign capital coming in, it's really the demand from the foreign investors that are more interested in coming into the market. So I mentioned before as well that the opening of China's capital markets to foreign investment will continue in 2013. And so this will be a combination of the government increasing the quota, and so allowing more money to come in, and changing the regulations and the products that are offered so that companies can use different vehicles to come into the market and use different products to invest in the market. One of the comments that we saw recently was a comment by the head of the CSRC, who commented that the QFE and renminbi QFE programs were still small. They represent about 1.5% of the market capitalization in the A-share market today. His intention is to potentially bring that up to 15%. And so how that's going to happen is firstly, the number of QFE licensed investors is going to continue to increase, and better access to domestic investment products. So we'll see a lot more products come into the market, similar to the index futures that recently, in the past couple of weeks, it's been announced that QFEs will be able to use. In the future, we'll also see the QFE2 and RQFE2 program, and this is going to be more targeted towards high net worth qualified foreign individual investors. So looking more at individual investors as opposed to institutional investors that the QFE and RQFE programs traditionally looked at. When we look at the number of licenses in the QFE program, you can see that since its inception in 2003, there have been kind of in the tens numbers of licenses were allocated, but we saw a very strong uptick in 2011 and 2012. And again, that goes back to the government realizing that they want to have more foreign capital in the market. So the number of companies that are licensed to trade in the domestic markets through the QFE program will likely only increase as we go forward in 2013. As well, pointing to the comments that Guo Shuqing made, it could go up to 15% in terms of the market capitalization. That's kind of the unofficial goal that Shuqing said when he was speaking at a conference, I believe, in Hong Kong a few months ago. So moving quite a bit from the 1.5%, which doesn't really affect the market here, to 15%. So that'll have a much greater effect on the market in China. So that's looking at foreign capital in China. And for any of these trends, please do take a look at our report that will have more detail on all of these. I mean, we don't have time to go into too much detail on each one, but the report will have more detail on each of these. The next trend I wanted to look at were new financial derivatives. And this is likely to be a combination of a number of new products and derivatives available during the market in 2013. Specifically in the commodities futures space, looking at things like egg futures, crude oil, gold, and charred coal will likely come online over 2013. And when you look at egg futures, it's kind of something you don't see all the time, but it's like pork and like a lot of other commodities, that's a key part of daily life for the average Chinese individual. So, it offers a little bit more direct correlation with what's happening in the day-to-day lives of the average Chinese, those futures that are looking at something that's a fundamental staple like an egg. As well, these futures will allow a lower cost of investment entry, so the account minimums that you would need to trade some of these new futures, like the egg futures, would be much lower, and likely the contract value will be much smaller. So the kind of barriers to entry to actually trade these from a practical perspective are going to be lower in the future than they are now. Financial futures, government bond futures, which we'll talk about a little bit, and options on futures, so essentially second order futures, we should likely see in 2013. The government bond futures is kind of an interesting topic and necessitates a little bit more discussion. Government bond futures aren't actually new for the Chinese market. Originally in 1992, the Shanghai Stock Exchange launched government bond futures, but there was a bit of an issue in March of 1995. There's a battle between one of the large securities companies here in China and the government, and although the securities company prevailed, so to speak, in the end, the government intervened in the market, ended up arresting the chief manager of that securities company and actually shut the market down for government bond futures. So it was it was a bit of a false start for the market. But this reopening of the bond futures market is really an important market signal, because it shows that reform is moving along, and that the government recognizes that some of the things that maybe hadn't worked in the past will be working in the future. And so this is something that a lot of the institutions have been asking for as a way, as a hedging mechanism. And it's such an important part of the economy here that it's clear that this is part of the government's plan to really expand and reform the markets. And the final point is new futures options. So looking at kind of what we call second order derivatives are another form of futures that we'll be seeing into the market in 2013, likely. So the third and final trend that we wanted to cover today in the capital market side, before we go into the top 10 trends on the banking side, were hedge funds. And this is something that's been talked about for a while, but we really feel that this year is kind of a watershed year for hedge funds in the market, not only because of those reforms that we've been seeing, so looking at government bond futures and other more traditional hedging mechanisms, but also because the demand from the investors. So if you look at the markets today, the A-share market is on near-term lows, which represents a relatively cheap opportunity to get into the market. And as I mentioned before, although it's growing more slowly, the Chinese economy in general is still one of the fastest growing in the world. So it offers a better investment return. So these two factors are really driving funds and external investors to want to get into the market and to take advantage of the growth that's happening in China. So those are two of the drivers. And this is leading to more demand from mature financial industry, and that's both from the government and from the investors. The investors just mentioned the lack of investment channels, products for high net worth individuals. The average investor here in China doesn't have very many channels to invest their money, whereas hedge funds, local renminbi denominated hedge funds would be able to offer another product for people to invest in. And the flip side of that is government initiatives. If you've had a chance on our website, we have another report that we co-authored with the American Chamber of Commerce here in Shanghai, looking at Shanghai International Financial Center 2020. And so Shanghai as an international financial center is something that's been talked about for years, but it was only a couple of years ago that the government formulated and formalized its plan to actually make Shanghai an international financial center along the lines of a Tokyo, a New York, or a London by 2020. So there's a number of things that need to happen before we get to that point, but clearly it's in the government's sights and it's something that they're looking at doing. So although the market seems to be ripe for hedge funds to enter, there are some barriers to entry and there are some challenges that they face. The first one, we mentioned this before as well, is a lack of a mature credit system. A lot of the financing these days goes to SOEs and larger companies and doesn't necessarily filter down to the small and medium enterprises. Regulations, both from the perspective of what the regulations should be. So number two, the regulators are still unsure about what hedge fund governments should be in China. It's not clear cut what the governments should look like and what the regulations should be to meet that level of governments that they're looking for. And secondly, the point number three is that there are multiple government industry regulators, and kind of ownership of hedge funds is unclear. So it doesn't belong to the banking regulator, doesn't belong to the securities regulator. Previously, there have been a number of insurance products, wealth management products that have come out of the insurance industry. So it's a bit unclear who would manage the hedge funds, as well as getting consensus for any of those to move forward in a particular direction is a little bit more challenging. In addition, there are already local competing products. So there are private equity funds that are now here in China, both in US dollars and renminbi. There's trusts, wealth management services, and in China, these are considered substitutes for hedge funds. So if hedge funds come in, would they be able to compete with those? And currently, the last point, number 5, is that really the QFE program and QDLP program are the only two legal means for hedge funds to enter. But the QFE quota isn't allocated to hedge funds, and QDLP is more suited really for private equity investing rather than hedge funds, as it's not really suitable for large-scale financing. So although there are lots of opportunities for hedge funds to enter the market, there are some challenges and kind of barriers to entry in that as well. Fundamentally, though, if you're a hedge fund looking at the market, there are three ways that you might look into getting into the market. And indeed, the hedge funds that are here in China now tend to be operating in more of a gray market area. So a lot of them utilize retail trading accounts using local citizens' ID cards. So they would go around to their company and collect ID cards and open up retail accounts on behalf of those individuals, and then trade as a hedge fund through those accounts. Or they trade in Hong Kong. So that's either trading H shares directly in Hong Kong, which gets exposure to China and the financial markets, but not yet a perfect hedge, or using some of the additional China hedge products in Hong Kong. So some of the index ETFs there that are in Hong Kong that are, or some of the stocks, some of the dual listed stocks that are there in Hong Kong. So the opportunities are large. There are challenges, but we still see hedge funds being a strong area for growth in 2013. And one of the next reports that we're going to be doing within the capital market space that should be published in March or April of this year is looking at hedge funds in China. So essentially, if you're a hedge fund abroad and you're looking to come into the market, what are your opportunities? Where should you invest? Which markets should you use? And how would you get into the market? Will be one of the reports that we're going to be covering later on in Q1 going into Q2. So those were the three capital markets trends that we wanted to cover for this, and here are the top 10 China banking trends. And I should say, and I think Paul mentioned this at the beginning, don't feel the need to write all of these down. These slides will be available for you to download, as well as the reports for free of charge. The slides later this week, and then the report when it's published early next week. So looking at the top 10 China banking trends, there's three that we wanted to talk about in specific: online to offline business, big data for China's banks, and SeaNAP 2, or China's National Advanced Payment System version 2. So the first one we wanted to look at was online to offline business. So the market situation right now, when you look at e-commerce in China, there's an incredible amount of online shopping that's happening in China. E-commerce transactions are growing rapidly. They're projected to rise from 7.5 trillion from last year renminbi to 18 trillion renminbi in 2015. And that will make China the largest global e-commerce market across globally, actually. And so hand in hand with the development of e-commerce, online shopping is becoming increasingly popular with 221 million shoppers at the end of 2012. And you can see from the chart below that that's expected to increase to 363 million in 2015. So this is really changing the dynamics of how people shop and how people buy goods in China. And really, that's one of the key drivers. So online shopping growing rapidly. But the challenge for a lot of these retailers, whether they be offline or online, is decreasing margins, because there's quite a bit of price competition, especially in the online space, where you have some of the big players like 360 Buy or EDNHow that are really competing on price. I mean, the delivery and the logistics they offer, you can buy something today and it'll be with you tomorrow. What other ways can they differentiate? And it's typically through price. We're seeing increasingly fierce competition, both online and offline. And with the offline consumption and the competition in that space, we're seeing more physical retailers wanting to move more online. So that online space is becoming even more crowded and more competitive. So online to offline, really, if you think about the traditional Chinese connection with cash, China was very much a cash-based society years ago. So shifting that to completely online and completely electronic and card payments has been not a very quick process. So online to offline is a way to kind of bridge that gap and allow customers to shop online but still pay offline. To give you an idea of how this might work, I could go onto my computer here in my office, I could order something online, and then instead of paying for it online, I could go downstairs to the local 7-Eleven mini mart, and I could swipe my card in a terminal that's located in the shop and pay for my transaction there. That would automatically be reflected on my account, and then the goods would be shipped. So, you don't have to necessarily use an Alipay or a PayPal to complete the transaction. You can use your debit card offline and essentially pay through one of the local terminals or one of the local point of sales. So what that offers is it's more interaction opportunities for both users and businesses. If you think about, if I complete that transaction completely online, that's one chance for the retailer to interact with me. Whereas if I complete it offline, that's two opportunities. So initially when I place the order online, and then when I go to pay it offline, that's two interaction opportunities. So there's actually quite a bit of value that could potentially happen from this online to offline business. And as we'll see on the next couple of slides, some of the companies are really starting to take advantage of that with things like LBS, so location-based services, group buying, and cash on delivery, or COD. And it's worth mentioning that before online payment systems like Alipay came online, cash on delivery was very much the preferred method. So you would order something online, it would be delivered, and then you would give the delivery person cash. And that still happens today. And you can still, that for many of the goods that you buy, that's still an option. So the number of online to offline users for shopping increased 65% in 2012 and is projected to be over 80% of total online shopping in 2015. So this is going to be a big segment of the online shopping population. And the shopping value has grown significantly as well. So it will grow in excess of 50% annually from 2013 to 2015. So in terms of what this means for the future, there should be a lot more investment in the online to offline business, and we're already seeing that. If you look at Alipay as the example that I mentioned before, so the terminal that's in the 7-Eleven that's downstairs from our office here, that was installed by Alipay. So that's a point of sale terminal that they funded to facilitate this cash on delivery. So essentially expanding the number of people that could be potential customers based on the fact that they want to pay offline as opposed to paying online. And Baidu has set up a location-based services department specifically to develop their online to offline business. So it's becoming a really important part of a lot of the businesses here in China. Dianping is another good example. It's if you ever go out to dinner with a young Chinese person, if before they go to the restaurant, inevitably they'll load up Dianping on their mobile phone and they'll check out the reviews for that restaurant. You can type in, I'd like to have Sichuan food near where I'm standing right now, and using location-based services, it'll pick out Sichuan restaurants nearby you. It'll give you the ratings. It'll tell you who's there. There's a lot of functionality that's built into that, so that we're seeing more models like Dianping come into place. So what this means for IT vendors is that there's a lot of opportunities for software solutions, especially intelligent software solutions. So things that are looking at business intelligence, data mining, loyalty, and value-added services, ways to get more out of the data that you're getting. And we talk about big data next. And as well, hardware in terms of IT infrastructure, point of sale terminals, and mobile devices. These are all things that are necessary for this value chain and are a key part of what these companies are investing in. So that's a good segue into the next trend that we wanted to talk about, which is the big data era for Chinese banks, and the big data challenge for Chinese banks. So if you're familiar with big data, it's essentially the tremendous amounts of data that we have about our customers as a financial institution. So what are our customers buying? How are they investing? How much money do they have on deposit? What are their trends in deposits, withdrawals? It's taking all of that information and really building intelligence out of it. And that's somewhat new for China's banks. So if you look at where China has come from, in the early 2000s, there was no such thing as a consolidated back end for a lot of these banks. If you look at the history of Chinese banks, they were traditionally operated as very provincial level banks. So Bank of China, Beijing as a province was different than Bank of China Shanghai, was different than Bank of China Sichuan. So there's a number of different provincial level banks that each had their own back end and data warehouse. And it was only in 2003, 2004, and I believe China Construction Bank was the first of the big five anyways, to consolidate their back end. So basically take all of that data that was spread across all of these provincial level banks and bring it all together. But the problem is now that the banks have that data consolidated in one place, the question is what to do with it. And really, as competition is increasing, both domestically from banks that are innovating domestically. So when you look at, the big five are traditionally the hold the majority, 80 to 85% of all of the deposits in China, the retail deposits in China. There's a lot of competition they're facing from upstarts in the form of both city commercial banks and joint stock commercial banks. So city commercial banks such as the Bank of Beijing, the Bank of Shanghai, as well as joint stock commercial banks. So banks like China Merchants Bank, Shanghai Pudong Development Bank, that are coming up and really starting to take away market share from the big players. And in addition to that, of course, we have the foreign players coming in. So the HSBCs, the Citibanks that are starting to be allowed to offer more products and services in the local marketplace. So really, how do the big banks differentiate themselves? Well, a large part of that answer needs to come from big data. It needs to come from being able to understand your customers, enhance that experience with the customers, to both acquire more customers, to acquire more share of wallet, and pretty much offer better service than the other banks are offering. But there are a lot of challenges in this, and we're seeing this in other markets, but we're also seeing it in China as well. There's there's a tremendous amount of real time sensory data. So this is kind of essentially customer behavior data, whether that's looking at queuing times in branches, what people do when they come into the branch. If you have video in your branch and you watch, what the customer pathway is within the branch, there's a lot of data to be extracted from that. There's different types of data from different channels. So social media, mobile, online, physical branches. The question is really how to bring that all together, to store it, to analyze it, and to be able to make those conclusions about your customers, to change your business model and to become more competitive in the market. And really what's needed to do that is a high performance and stable IT infrastructure to be able to support that. So, the ability from a hardware perspective to be able to handle the data queries, to be able to handle the analysis, and the ability from a software perspective to quickly be able to find the right data, to access that data and be able to draw conclusions on it. This inevitably is going to, the banks that are able to do that allows them to build stronger customer relationships and improve their risk management. And it also helps for a lot of the banks, the Chinese banks that are expanding abroad. So if you look at the banks like ICBC and Bank of China, they're expanding abroad not only to get access to currency, but they're expanding abroad to support their existing customer base as their customer base expands abroad as well. So really that, kind of starting at home and understanding what your customers are looking for here in China will help those banks as they expand abroad as well. So what does this mean for vendors? Well, it means more opportunities. Analyzing this level of data, this big data, can't be done with traditional databases, legacy databases and architectures. It needs new approaches and new analytics systems to be able to analyze the information, as well as new databases and hardware to support that. And so correspondingly, we're seeing that data mining and business intelligence banking spend is going to increase dramatically over the next few years as banks continue to invest in this space and really try to get more out of the data that they have and the data that they're collecting from the customers. So the last trend we wanted to talk about tonight is China's SeaNAP 2. Fundamentally, before 2007, there wasn't a consistent national payment system. There were a number of individual payment systems that were tied together in a loose framework. And it was only in 2007 that China launched SeaNAPs, or the China National Advanced Payment System. And it's composed of three parts, as you would likely expect in other markets as well. There's a high value payment system, which is real-time processing of large value payments. There's a bulk entry payment system for more smaller value payments, and then a settlement account processing system, which is related to settlement accounts. In 2012, the second generation of the SeaNAP system was launched to make both the processing of domestic and cross-border renminbi payments more efficient among banks. Fundamentally, the advantages of the SeaNAP 2 were increased efficiency, safety, and lowered cost. So currently, there is a unified connection. So previously, each banks had to have several connections essentially into the payment system to be able to transact and to process payments. But now there's just one connection to the system. And also, they've adopted some of the SWIFT standards, which obviously makes cross-border payments and transactions much easier. And that's largely down to the government's focus on making the renminbi, a globally recognized trade currency in the market. So the implications for banks of SeaNAPs too is they need to update their payment systems and optimize their front ends to basically connect with the new system. It will be more efficient and will allow for faster processing, but it also means that there need to be higher standards on risk control because the payments are going to be going through faster, and there's more chance for error in that. So there needs to be higher focus on risk control, and spending on payment systems will continue to increase in the future. So really, vendor solutions, they need to be able to connect in. So connect into SeaNAP smoothly. So that needs to be a functionality that's there now, as well as it needs to be able to support real-time payments and be stable is probably one of the more important things, to be able to handle the volume of transactions that are going through and the volume of payments that are going through. There needs to be automatic account checking built into the system, high efficiency, and again, the ability to process large amounts of data and to be able to find correct errors through the monitoring system, and then the fault tolerance and repair function that goes along with that. So that's really what we had for the top 10 banking trends for 2013. And as I've mentioned before, we'll be putting the slides up in the next couple of days for both, all of the slides that you've seen today, and then the availability of the two reports. So they will be separated into two reports. Will be during the middle of next week. So we'll actually be working through the Chinese New Year to get those reports to you, and they'll be available on our website on kapronasia.com. So with that, I think we had some questions come in while we were going through it. So I wanted to turn back to Paul, and maybe we can go through as many questions as we have time for.
Okay, thanks very much for that, Zenon. That was great information, and you're right, we did have a few questions come in. I'm just going to sort through them here quickly. Actually, the first one came in, and I think you addressed this while you were talking anyway, but Mark asks, do you expect mainland firms or global players to attract the most market share? And I know you talked about that a little bit before, but there's obviously a lot of players in this market as well. So any bets on who's going to get the most?
Yeah, I think, when you talk about the banking first, I think, actually both in banking and capital markets, I think a lot of the Western companies, to be quite honest, are much more advanced in terms of their processes, their products, and their maturity in the market. So they're definitely coming to the table with a better set of products and understanding of how banking works and how the products could come to the marketplace. I think the challenge that they face is that the local banks are the trusted banks. And the local firms are the trusted firms. So these are the banks that have been supporting the state-owned enterprises for the past 30 years as the economy has opened up. And they're the banks that consumers have had their deposits with previously. So that's one challenge. And then the second challenge is the regulations that are in place. So if you look at the banking market, yet banks like HSBC, Citibank, Bank of East Asia, Hong Seng Bank have made big inroads into the markets over the past couple of years, but they're still somewhat limited. The amount of capital that they need when they open up a new branch, when they expand their business, is still quite great. So those will still be hindrances for them, and that's both on the banking side and on the capital market side. If you look at the capital market side, to offer asset management services or to be a brokerage, you need to have some sort of JV set up here in China with a local Chinese institution. So that strongly limits what the foreign institutions are available to do in the market. I think it was only last year, I think CLSA might have been the first brokerage house that was allowed to actually provide brokerage services here in China. And that was only because they had a joint venture in place for 5 years beforehand. So there are quite a few regulations that are in place on that side. So, I think, will the foreign firms continue to make inroads? Yes, of course. I mean, as the regulations loosen and as they're allowed to do more business in China, as customers become more comfortable with them, they will definitely have more opportunities to do business. Will it dramatically increase in the next couple of years? Probably not. I mean, it will still be very gradual as it has been over the past 4 or 5.
Okay, thank you for that. Right, the next question comes from Henry. It says, in looking at all of the trends you have identified for 2013, what do you feel has been the biggest influencer in these trends? Or in other words, is it the government that's influencing the market, or are they being driven by investor demand, or is it consumers that are actually pushing the market?
Yeah, that's a good question. I think it sounds like a very cheap and trite answer, but I think it's all three. I think you see from the government side, you're starting to see more initiatives like Shanghai IFC 2020, so more commitment from the government to reform both the capital markets and the banking markets. When you look at their 5-year plan, financial innovation came up several times, and although the 5-year plan is kind of vague and doesn't lay down specific things that the government is going to do to achieve any of those goals, it's clear that reform of the markets needs to happen, and that's part of China's want to be a fully global player, as well as to the trends that I pointed out earlier with money coming in. So China still wants to attract more investment into the market, and so that'll still be a need. The consumers in China are getting more sophisticated, both in the capital market side and in the banking side. So what they're looking for in terms of products, you have a lot of high net worth individuals that previously have only really been able to invest in either bank deposits, which pay peanuts here in China, or in real estate. And that's led to a lot of the asset bubbles in China. So we're seeing the government clamp down a little bit more on real estate as being to prevent that from being more of a bubble, which makes it less attractive for investors. So the investors as well are demanding that, and that's both investors domestically and investors from abroad. When you look at the QFE quota utilization, it's nearly 100%, which means that every firm that has been allocated QFE quota, in other words, quota to be able to invest in A-share markets, is fully utilizing that quota. Whether that's them using it themselves or them lending it out to other investors to use on their behalf, it's really an indication that there's a lot of demand for investing in China. So really, it's a combination of all three. I think that is driving the changes and driving the reform in the market.
Okay, thank you very much for that. All right, we're running up close to the quarter of the hour here, so I think we've got time for one more question. And this is actually coming from a couple of people, and so it says, though we didn't really cover it in the presentation, there was a question from John that came in about mobile payments. Is this actually going to happen in China this year? There's already so much talk all over Asia, but so little action, and that actually was a similar question that Vittorio was asking. What about mobile banking? So mobile payments, mobile banking, is it a trend? Where do you see that going in 2013?
Yeah, it's a good question. We looked at mobile payments last year in one of our industry reports, and it's a really fascinating area. I think globally nobody has mobile payments correctly. The examples that you hear of initiatives like M-Pesa or some of the other remittance solutions that are out there, or payment solutions in the States like Square, they get a lot of fanfare, but the percentage of people that are actually using them is quite small. And I think that challenge somewhat still exists in China as well. I would say the one thing that's different in China, though, than other Asian economies, I was quite surprised when I went to Hong Kong last time. I was able to use my Octopus card nearly everywhere. So you go to the 7-Eleven and you can pay for your goods at the 7-Eleven with the Octopus card. You can go to the local pool and you can go swimming in the pool by swiping your Octopus card. You can use it obviously on mass transit in Hong Kong, whether that's using one of the trams or a bus or the metro there. So there's Hong Kong has essentially created a default payment method, which is the transit card, the Octopus card that people are using there. So China doesn't necessarily have that. It's partially down to the fact it's such a big place. So Beijing transit cards can't be used in Shanghai, which can't be used in Shenzhen. So there hasn't been that kind of nationwide form of payment that has been adopted in other places like Hong Kong, like London, like Singapore. But I think That's not necessarily a bad thing for mobile payments in China. I think there is a demand for mobile payments and mobile banking in China, especially when you look at the number of unbanked or underbanked people across China. There are a lot of geographical issues that come into play that are preventing people in the far west who may not have a bank near them to be able to conduct financial transactions, and so that will drive the market. And we're seeing various different initiatives. It will take government intervention to come up with a set of standards, but in all likelihood, that will come from a China UnionPay initiative or a China Mobile initiative or China Mobile Pay. The joint venture between the two that's focused on that. But I think we may see that happen in China before we see that happen in other markets. The argument in Hong Kong or in Singapore is, why should I use something different? Mobile payments, if I have to open up my phone with a PIN, if I have to load up the application that I use for mobile payments, that's going to take me longer than swiping my card, which is working fine for me now. So in those markets, I'm not sure if we'll see mobile payments take off, but I think there's still quite an opportunity here in China, especially when you get on the metro and you see the number of people with smartphones today. It's incredible. It's really a changing space here in China, and I think it's something that we'll see develop a lot in 2013.
Okay, great answer. Thank you very much for that. Now, it looks like we've actually gone over a couple of minutes over here, which means that we're unable to get to all the questions that have been submitted today. So we've been busy answering those in the background. If we haven't got to your question, we'll be responding to you individually and get back to you in the next couple of days as well before the vacation here sets in. Now, as mentioned during the session today, today's discussion was based on Kapronasia's upcoming 2 reports on the top 10 trends in China for 2013 in the capital markets and in banking technology too. Now, these reports will offer a critical insight into the key industry trends in China and explain how they'll affect the technology spends of banks and financial institutions. If you haven't already registered for this valuable service, we'll also be providing a link to do so in the email you'll shortly receive thanking you for your attendance here today. This email that you'll get will also contain a link to the recording we've been making of the presentation, so that way if there's any information you've missed or you want to listen to it again at your own pace, you certainly can. Now, once again, Kapronasia appreciates your time today. Hopes you found the information informative and helpful. This concludes our webinar today. Thank you very much for joining us, and thank you, Zenon, for the great presentation.